What if I told you that in 2008, some of the most powerful financial institutions on Earth created $16 trillion out of thin air? And most people had no idea it even happened. Imagine it's September 2008. Lehman Brothers has just collapsed. Markets are bleeding. Your retirement account suddenly looks like someone cut it in half overnight. You turn on the news looking for answers, and there's benbernanke.com and reassuring, announcing emergency measures. What he does not say clearly is that the Federal Reserve is about to create more money in a few months than existed in the entire US economy only a few decades earlier. And the wild part is, they didn't print a single physical dollar. No machines, no ink, no armored trucks delivering stacks of cash. They typed numbers into a computer system, and just like that, trillions of dollars existed. Digital money appeared in bank accounts like magic, backed only by keystrokes and government authority. Most of us grew up believing money came from the mint, that the government prints bills, coins, and that's where money comes from. But physical currency is less than 3% of all money in circulation. The other 97% is created by banks through a process so strange, so counterintuitive, it almost sounds like fiction. But it's not. It's documented fact. And understanding how this really works might be the most important financial lesson you never learned. This matters because the money you earn, save, and rely on, almost all of it was created through this hidden mechanism. Normally, when something goes wrong with this system, ordinary people pay the price. It happened in 2008. It happened in 1929. It's happened again and again throughout history. Just to be clear, this is purely educational. No financial advice. No political agenda. Just the mechanics of how the modern monetary system works, because it affects your purchasing power, your job security, your economic future, and even which groups consistently benefit while others consistently fall behind. And here is why this is especially relevant right now. The same warning signs that appeared before past crises are flashing again. Debt levels are at extremes. Central banks are conducting monetary experiments with no historical precedent. And most people have no idea how fragile this makes the system. By the end of this, you'll understand how banks actually create money, why that process creates boom and bust cycles, and what the historical patterns suggest about where we're heading next. Once you see the hidden machinery behind our financial system, you can't unsee it. So, let's get into how this system really works. Here's where things start feeling surreal. When you put $1,000 in your checking account, you naturally assume that money is sitting safely in the bank. But it's not. The bank lends it out almost immediately, yet your account still shows the same balance. You can still spend it whenever you want. That same $1,000 now exists simultaneously in two places: your account and the borrower's account. It's a legal magic trick, and it's the core of our entire banking system. Banks only have to keep a tiny fraction of deposits on hand. Historically, it was around 10%, but in 2020, that requirement went to 0, meaning banks can lend out basically everything you deposit. And then the chain reaction begins. The borrower spends that $1,000. Someone else deposits it. Their bank lends out $900. That gets spent, deposited, and turned into another loan of $810. This process continues again and again until your original $1,000 has multiplied into roughly $10,000 of total money in the system. Economists call this the money multiplier effect. It's financial alchemy. This isn't theoretical. Between 2008 and 2014, When the Federal Reserve injected about $3.5 trillion into bank reserves, the system had the potential to create over $35 trillion in new money. But this entire system only works as long as everyone doesn't ask for their money at once. It's built on confidence, not on actual reserves. And when confidence breaks, everything changes fast. Because there's a dark side to money creation, money destruction. Every dollar a bank creates begins life as a loan. When loans get repaid, that money disappears. It's removed from existence. And when loans don't get repaid, when people default, money evaporates even faster. This creates a naturally unstable system. Banks are incentivized to lend aggressively during good times. They loosen standards to chase profits. We saw this during the housing boom in the 2000s. Banks approving huge mortgages for borrowers with no income verification. Why? Because their competitors were doing it, and saying no meant losing profit. This fuels a feedback loop. More loans create more money, which increases spending, which increases asset prices, which encourages more lending. Everything looks great until it doesn't. Eventually, something breaks the cycle. Interest rates rise, debt becomes too large. A geopolitical shock hits. Suddenly, borrowers can't repay loans. Banks panic and stop lending. Money stops being created. Instead, it starts being destroyed as loans default, and the multiplier runs in reverse. Between 1929 and 1933, the US money supply dropped 30%, not because the government destroyed money, but because defaults wiped out bank-created money faster than banks could replace it. Over 9,000 banks failed during the Great Depression. Each failure erased deposits and eliminated the bank's ability to create money. The truth is, the boom and bust cycle isn't a flaw in the system. It's baked into the design. The same mechanism that drives rapid growth also guarantees sharp contractions. And when the contractions hit, governments face a terrible choice: let the system collapse or step in. Every major country has chosen intervention. That's where central banks come in. They act as lenders of last resort, creating money to bail out financial institutions, stabilize markets, and keep the system from imploding. In 2008, the official bailout numbers, like the $700 billion TARP program, or just the surface. The Federal Reserve lent out over $16 trillion in emergency support worldwide. Europe printed trillions. China created enormous stimulus packages. Central banks used digital money creation to stop the chain reaction of defaults. But this leads to moral hazard. If banks know they by rescued, they take bigger risks. If you got to keep all your casino winnings, but the government reimbursed your losses, would you gamble more carefully or less carefully? That dynamic explains why major banks became even bigger and riskier after 2008. And once governments and markets get used to central bank support, they become dependent on it. Japan has been stuck in this pattern for decades. The Bank of Japan now owns more than half of the country as government bonds and large portions of the stock market. They can't stop creating money without causing collapse, but continuing creates distortions that grow harder to unwind. This brings us to the consequences, the things that happen not immediately, but inevitably. The first is inflation. When central banks create trillions, the new money doesn't show up in your bank account. It goes first to banks, big institutions, and asset markets. Stocks rise. Bonds rise. Real estate skyrockets. Those who already have assets benefit. Those who don't, they watch prices move further out of reach. For most of the 2010s, Official inflation looked low, around 2%, but housing doubled. College tuition climbed. Healthcare soared. Stocks tripled. That's inflation too, just in different places. It's called the Cantillon effect. The people who access new money first benefit the most. Another consequence is the rise of zombie companies businesses that should fail but don't because they can borrow endlessly at near zero interest rates. They don't grow, they don't innovate, they barely survive. Japan's economy has been full of them since the 1990s. Europe followed the same path after 2008. By 2020, about 20% of major US companies qualified as zombies. These companies clogged the economy, consuming workers and resources that could be used productively elsewhere. This helps explain why productivity growth stagnated in the very decade we invented smartphones, commercial AI, electric cars, and genetic engineering. And then there's the biggest problem: government debt. Money creation allows governments to spend far more than they collect in taxes. They issue bonds, central banks buy those bonds with newly created money, and deficits get financed painlessly. It's like giving yourself an unlimited credit card and also running the bank that approves the limit. US debt has climbed from 10 trillion in 2008 to over 33 trillion today. Japan's debt is more than 2.5 times its GDP. Europe consistently breaks its own debt rules. This system works only as long as interest rates stay low. If rates rise even modestly, governments face impossible math. They either default, slash spending, raise taxes dramatically, or print huge amounts of money, each option with severe consequences. We've seen how this ends in countries like Argentina, Venezuela, Lebanon, and Turkey. The US has held up longer because the dollar is the world's reserve currency, but history shows that no reserve currency keeps that status forever. So now we circle back to the original question. How did institutions create $16 trillion out of thin air in 2008? And why did most people never notice?